Okay, so why stock option strategies? Well, the first thing is you want to lower your cost basis. At E-option, it is only 10 cents a contract, much lower than other firms. So that right off the bat is how you can help your bottom line, whether you're in profitable or losing positions. No matter what, you do have a cost of transactions, which is very slight and small with E-option. Options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, especially with the technology stocks right now that are just on a crazy run when you look at markets like Tesla and stuff like that. And we're going to get into these examples, and you'll see how options can actually benefit you as a trader and also as an investor, using derivatives such as options to give yourself more of an opportunity to take advantage of market movements. Options allows the smaller to larger investors the ability to capitalize on these trendy markets that are highly liquid, okay, which also helps out in whenever it comes to trading. You always want to trade a highly liquid market. This is a very important cost control because if a market is illiquid, you typically have high spreads getting in and out with typical options. The major markets, the spreads are very, very tight, so you don't have to worry about any real slippage from getting in and out. You're not giving up much of an edge from the entering and exiting of your transactions. So trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk, so that you have a higher return on your investment potential, and you also have much more controlled risk. So now with that, let's jump into what we're going to focus on today. So long puts and long calls, very simple. You will be buying, excuse me, the puts or the calls. The one thing that's nice about this kind of strategy, besides that it's a very beginner strategy, it's also used by advanced traders as well. The nice thing is there's no margin. So right off the bat, you don't have to worry about that. Your risk is defined. Your risk can only be what it costs for the price of the option and also your commission. So it would be that price plus 10 cents if you were using E-option per option. Then there's also simple execution, getting long and puts and calls. Very liquid in all your major stocks, so it's not a hard thing to execute. So right off the bat, those things give you an edge in the right direction, especially when because it helps to keep your losses from being exacerbated, and it also keeps your winners from being less than what you deserve. So the volatility, direction, and cost, the commission spread, are the key variables, and that's once again helps is why the simple execution, since we have such high liquidity, we don't have to worry about that. Now obviously, if you're trading a number like when earnings come out or some major economic number, at that time when the market starts to go haywire, you're probably going to have a little bit more of a liquid spread than you would have during the normal trading day, even if the market's in play. So that is something you do need to take into account. Nothing is steady 100% of the time. Those would be the only times you probably really have to worry about it the most. So that would be right around the opening and closing of the markets during the trading day, and then also, like I said, major economic numbers. So with that, let's get to our first example. Wow, we would get into our first stock example. So long stock and short stock. If you are long, you are a buyer of stock, okay? If you're short stock, you would be a seller, okay? So this would be the equity way of trading a call or a put, okay? So the difference though here is that if you're long the stock, meaning a buyer of stock, versus buying an option, your capital outlay can be very high. And through our examples, you're going to see the difference between some stocks versus some very expensive stocks or high volatile stocks. Then here's the thing is, if you are long the stock, you do have the potential for dividends. That's a plus. That's the only one thing that if you buy the stock versus any of these other things we talk about, you would have the potential for that. The one thing though is it ties up capital and limits diversification. Your risk is capped by your capital outlay and also your potential for margin. Now here's the thing is, for short, if you were to sell short the market, the equities, you have your margin capital is very high and must be maintained. You will not have dividends like as if you purchased the stock. It ties up capital and limits your diversification as well, and your risk is unlimited. Not so good for anybody. So now options, long puts or long calls. This is the reason why we picked this strategy. It has a high potential ROI, which is a good thing. It has limited risk, which is a good thing. Flexible medium, meaning liquidity, which is a good thing. And potential rise in volatility, which is good. Because when you are buying options, the one thing that does always go against you is time decay. But if volatility goes down, that also hurts you as far as the price of the option. But then if you have the volatility goes up, it helps you as far as the value. So when you purchase it, if volatility goes up, it helps to maintain the price of that option. And we'll talk about that as we get into it. The negatives of these scenarios, though, is the time decay, the potential drop in volatility, and the fact that there's no dividends on this one either. So, like, once again, only if you were to buy the stocks would you get dividends. Now, the negative is that the potential drop in volatility would, just like time decay, would erode the pricing of the option that you had purchased. Because remember, you're purchasing these trades. So our first example is going to be old big blue, IBM. So we looked when we started to figure out what we would do this, the topic for this webinar would be. We picked the date, and then I figured, all right, well, let's start with that, and we'll look at the options that go out. So this is from a couple of weeks ago. IBM had settled at $123.31. So at that time, before the market closed or the next following day, the trade would be, if you were bullish, you would be buying the 125 strike call, or you would be buying the 125 strike put, conversely, if you were bearish. So that's that green line there that represents the strike price that we're talking about. So now remember, if you are bullish, you would be buying the call. If you be bearish, you would be buying the put. Now, interestingly enough, when I pulled up this chart, the 2008 high, I went back to look and see how IBM has fared. You know, obviously it hasn't been doing well during the pandemic, let alone over the past couple of years. It's been trending lower. It's been kind of basing, I guess, for the last 2 years with some extreme volatility, obviously over the past few months. Now, the one thing that we look at here for the strike price for the 125 is how much does it cost for these options. So if you can see right where I have the expiration, it's the October 16th, 2020 option expiration. The 125 call was priced at $395, and the 125 put was priced at $545. Now, if you notice these blue lines here, 128.95 is your upper break-even price for where the market needs to get above or be above at expiration for you to be in a profit should you buy the call, okay, the 125 strike price call. Conversely, if you were a bear and you bought the 125 put at that time, you would need to have the market down at 119.55 for the option value to be at break even or plus. So let's go to the next slide and give you an idea of what this all means. So if you were to have bought the stock at the time of that when we did the slide, the 100 shares at $123.31 would cost you $12,331. So that's just for one block of shares. Now, the nice thing about IBM is that it's not quite the glamorous stock that you hear of in the news every day, but believe it or not, it still has value, and it's a big company, and it's still out there. The nice thing is that because of that, the volatility typically is not running at the levels like the stocks, say, such as Tesla or Facebook or, you know, Google and things like that, or Apple. So let's say you look at the buy the call 125 strike. Okay, that was $395. So that cost equals $395. Now look at that. To control 100 shares of IBM for the 30 to 45 days that you would have on that option from the time that was set, for less than you know, a third of a cost of the stock position, you could put on the option. You could buy the call, the 125 strike price. That's if you were bullish. Now the break-even price would be $128.95. And at that point, the call would still be worth at least what you paid for it or more, depending on how much time was left and the volatility at the time. Especially if volatility was rising and IBM, let's say, for instance, shot up to 140. Obviously, if that happened, you would be up all the money from the 125 strike price all the way up to, say, 140 minus the cost of the option, which would be that first $395. On the opposite end of this trade would be the put, which would be the 125 strike price put that was valued at 545. So that would mean that the cost would be $545. Remember that the multiples for option pricing for equities is times 100. So if it was $1, it was actually being $100. So now your break even on this trade would be if IBM was to break down to 119.55 or lower. So if you were bearish, you would be buying that put, and if you were bullish, you would be buying that call. Now think about the ROI on that. Now if you bought the stock, and well, then you have to be right for sure on the long side, because otherwise you're going to be at a loss as the market goes down. Now, granted, you can hold the stock for a long time, but then who knows how long, how much further it may break. If you were bearish this stock, but not overly bearish, it might just hang for a little bit, so then you get a little trade there. And if you were bullish and it only broke a little bit, it could just hang for a little bit, and you may have time, maybe collect some dividends, but you may not, but your capital will still be lower than when you got into the trade. If you were wrong and you bought the call, all you're going to lose is $395. Now, I don't know about you, granted that you only have a month and a half for the option, but you could do that multiple times over the course of the year. And for 10% of the cost of buying the stock, you could always be long at the money call. Eventually, you're going to probably see some movement, I would think, over a 12-month period. So would it work every time you try to put an option on? No. I mean, usually if you're going to be long or short the market, you should have a reason to have a buy signal or a sell signal. So this webinar is not going to be concerned with why you would buy or sell it. It's just a matter of what would happen. And now the same thing is also on the opposite side. Like if you didn't want to buy the stock, well, shorting the stock definitely has a big cost to itself. And then you have your risk is unlimited there as well. Now with buying the put, you would be able to play the bearish role on that trade right there at $1.20 to 125 and see what happens over the course of the 30 to 45 days. And if you get your market movement, then it would be, you obviously are right on the sell side, which would be a good thing. And it would also be much cheaper than doing the short. So just to let you know how things worked out, IBM as of yesterday, the 125 call was priced at 139, so that's obviously a loser. The 125 put was priced at 633. Remember, it was priced at 545 back when when the first slide was made a couple of weeks ago. So that being said, the market yesterday when it closed was at $1.2051. So it was just about $1 above the break-even price for the put. So even though now see there's time left in this trade, this is the new pricing is 9/22. It still has almost a full month left. So you have, besides the volatility pricing in, you have the timing pricing in. So that's why this option is not needing, it's already worth more than what you paid for it, and hasn't broken below there. But the thing though is, if the market stays where it's at right now, the time value will start to erode, and because it's above the break-even point, this put will eventually become worth less than when you first purchased it. So that's something you have to be mindful of. That you still have to get the directional move. That's what the whole point of putting on this trade is. It's a way of being short without the risk of shorting the stock. So now let's move over to our next example, we have Coca-Cola. So in this example, we use the $50 strike price. The blue lines indicate, once again, the pricing for the upside and downside. So the 51.22 up here above the 50, that would be for your call, which is $1.22. So that's where your pricing is. For your put, it's $2.06. So that would put us down to $47.94. So these are levels that you have to breach to for the long and the short side for the option at expiration to be worth a profit. So now let's look at Coca-Cola. If you were to buy the stock, the 100 shares at $49.53, it would have cost you just under $5,000. Now, if you buy the call for a $50 strike price, the price was only $1.22. That's very, very cheap. So that's for $122. You get to control 100 shares of Coca-Cola for up to 45 days. Now, the break-even point on that, like I said, was 51.22. Granted, the stock doesn't move like Tesla and all these other ones. However, it does move. It does move up. It moves down. So let's say you did have a reason to buy Coca-Cola, whether it's in front of earnings, you're positive you've got a really good hunch they're going to beat expectations, or just you have a buy signal for whatever indicators you use. Like for instance, let's say you had a high probable Japanese candlestick pattern, like one from my book, that was a buy signal for Coca-Cola. Then you would put on a call, and let's say that was the $50 strike price. So all you had to do was have the market go from the 49.53 where you started to above 51.22, and you are in the money. Now, if you were bullish the stock, think about that. $122 was the cost to put on a position that would be just under 5,000. Like your return on investment, which is your return, how much capital it takes versus your investment to give you your yield. This is where you make your money. Not only is your risk reduced, one, what your risk is always, because you're purchasing the option, remember, but it's much more reduced. Now, granted, risk brings on more reward. However, you're still controlling. The thing is, you got to remember, you're always only controlling 100 shares per option. So you got to figure out what's the value, in those options, and the same thing is with the puts. So let's say you had a sell signal for Coca-Cola. You're looking for a $2, $1.50 move. You're not looking for big moves here. But the thing is, you don't need a big move for you to make a profit. And that's the whole thing, is when it comes to trading and it comes to using options in a way of like this, where you're trading directionally, the whole point is to make money, So now if you were to buy the put and the call, that's a straddle. It's a totally different strategy. That's a totally different way. We did a webinar that actually discussed that a little bit. Look at the past webinars on eoption.com and you can find that out. But that's not what we're talking about today. Today, we're talking about whether you are a bull or a bear. So we're not giving you a reason to buy it right now, no signals, but if you are watching this webinar, we're showing you the difference on what you would do and how much you would cost. So your ROI, once again, with something that's a steady company like Coca-Cola, has really good potential here for the investor and the trader. Now let's look at the U-Haul. We all know that besides all the other airlines, United Airlines is no different than any other ones. It's gotten beat up really hard this year. A lot of volatility, and who knows what's going to happen over the next 6 months. Maybe the holidays start to bring people traveling, and then who knows, maybe we don't. But so we don't need to know whether it does or not. We don't have a crystal ball, and it doesn't matter. But look at this. It's kind of funny. The low for United Airlines in 2008 was $2.80. So it's kind of, we dipped down below $20 earlier this year, and now this market settled right around $36 when I did this example. So I picked the $35 strike. At that point, for the October 16th option expiration, the $35 call was $4.75. The $35 put was $3.65. Someone here was saying how to calculate the break-even formula. Is there a formula? Yeah, you can. I'm going to explain that to you right now in this example. So your break-even is always going to be the price of your option away from your strike. Like, what do you have to make? So, for instance, in this situation with the call, if you bought the $35 call, the price would have to be $4.75 away. So that would put it at $39.75. So at expiration, if the option was at that price or higher, that's the price, the value that you would have for that call. So that's where how you figure your break even. It's very easy to do. Now, granted, since this, if, let's say the market right now is trading at $40 and it was above the 39.75 threshold, it would be worth more than what you paid for it, obviously, because you have time still left. There's volatility priced into the option as well because there's time left. So then it wouldn't have more value than it does, obviously, when it started off. But at the end, to make sure that you break even at expiration, the market needs to be at least that distance away. And conversely for the put, so this is $3.65. The the $35 put, you subtract that, that puts it at $31.35. If the market is below that, the put value will exceed the price you paid for it, and you would be profitable in that trade. Remember that right now, we're not saying you should be bullish or you should be bearish. We're just showing if you were bullish, what you could expect, where are your thresholds for break even, and how much market movement you need. Now, the funny thing is, on any given year, you might be like, well, I may not be expecting that much movement in United Airlines, maybe a couple bucks a month on average or whatever, maybe $5 range, $10 range for the whole month, especially if there was a lot of news. But look at what we've had this year. I mean, it was up just shy of $100. It fell off its high in at the end of 2019, just below $100, and fell below 20 just a few months ago. So the odds of it moving more than a couple bucks right now are pretty decent. So giving that, these trades like right here, this is where you get a big bang for your buck. So think about this. I think we answered that question. So let's move on to why the UL example is a good example of why you trade options. So in this example, the price of 100 shares is only $36. Remember, it was at almost $100 less than a year ago. So the cost to buy 100 shares of UL is actually not that expensive anymore. It's $3,600. Of course, remember 12 years ago, the low in 2008, and that wasn't a pandemic low. The price of the stock was at $2.80. I don't know, maybe UL is expensive, maybe it's cheap. But if you were to buy the 100 shares, $3,600 would be your risk that you would have. Now, if you bought the call, if you were bullish, United Airlines thinking that, hey, you know what? Pandemic aside, traveling is going to start to come back a little bit. People are going to start to move for the holidays and get things moving. And, so who knows, whatever or you maybe have a buy signal. So the $35 strike would cost $475, which means that total cost would be $475 for one option that controls 100 shares of stock. And the break-even price would be that $39.75. So you don't need a big move considering the volatility that there's been in the UL market this year. It's very likely that at least if you were to stay rolling a strike price for a few months, that you would see a movement of more than $3, I would think, especially when you have an over $80 range so far this year. Now, if you were bearish this stock, thinking that, hey, the airlines are in trouble, they're just not making any money, they're going to have to keep on laying off people, and even if they do that, it's not going to be enough to keep their books afloat. We could have a lot of bankruptcy possibilities propping up. So puts right now, and especially when you look at the pricing, because the call is more expensive than the put, if you use that rationale, this is pretty cheap, $365 with a break-even price of $31.35. So for the market to get below that, that's not that hard to do. So let's see, we have a question. Are the VIX and the VIXN volatility levels artificially kept lower by algorithms or formulas? Oh, wow, there's a webinar into itself. Are they artificially kept lower by the algorithms or the formulas? No, I think that what you get is a lag more than an artificial lowering. And that's a whole concept and topic for a whole nother webinar. So I don't want to drift too far off of the topic with right now of just directional trading. What I can tell you though is that the VIX and even the VXN, the rising and lowering of them and the levels where they're at, definitely helps you when gauging your volatility for trades. So we can kind of incorporate the VIX, since you brought this in, and show you how this would be even come in with this trade. So here, let's look at Microsoft. Microsoft is one of those stocks like we mentioned earlier in the webinar. I said we would get to and talk about volatility, right? I mean, just this year alone, it had its little swing in February and March, but boy, did it bounce. And of course, everyone's using technology. Everyone's working from home. The kids are at school is at home, blah, blah, blah. I don't have to tell you what you don't know. So the 2008 high for Microsoft was 37.50. That was right before the market tanked. And then now it has come not only back above it, it's accelerated to $200 above it. Now, the funny thing is back then, Microsoft just bobbled around $35 for years. It didn't go anywhere. I mean, they made their money off their operating system and blah, blah, blah. But as a whole, they don't have the footprint like they have now. They've definitely bought into a lot of things that have helped to accelerate their growth. How long can that be maintained? I don't know. So, but just to get into the VIX, because of this accelerated slope of this rally, the volatility index from if the volatility index is really high, that would coincide with this slope of this rally. As volatility drops in the VIX, you would be able to tell that or assume that it's very likely that the volatility component of the option pricing will drop. Now, when you look at an option like Microsoft at these levels, unlike Coca-Cola or even IBM that was trading at $100 and something, it doesn't have the volatility pricing in. And volatility pricing, remember, these options that we're looking at right now are the same expiration date as the ones we looked at before. Now look at the price of the call and the put here. The 225 call and put, so this green line here is our strike price. The market closed at 225.53, so it was perfect. It's right in the middle. The pricing for these is very similar. So obviously the pricing, the call is very bullish with the slopes. The call is a little more expensive than the put, but they're $12.55 and $12. That's $1,200 per option plus just for 100 shares. Now, obviously, because of the $225 share price tag, it's $22,553 just to buy 100 shares. So the cost of that call, if you look at it on a relative basis, is still very similar to the pricing of what we saw in those other stocks. However, it's starting to get more expensive. So now if you want to get long Microsoft, and you think it's going to catch a ride, and now here's the thing is, you got to remember, you're buying the 225 strike price. Now you need to have a break even of 237.55 to the upside. So that's what kind of a rally you need. Now, the good thing is if the VIX is in a situation where it looks like it's rising, okay, that helps to keep the stock price, or your option price higher. So that's a good thing, especially as it approaches the break-even price point, or even if it doesn't go anywhere, if it's just staying sideways. So that's a thing that the VIX, if it's rising, can help you. Now, if it starts to go down, that's where it can hurt the pricing of your option, which means that the market really needs to get closer to your break-even price or get above it for you to get your money back and become profitable in your trade. The same is for the put, because this market was settling right at the same price as the strike price. Your put costs $12, so it's $1,200. Your break even would be a break below $213 for the stock price. Once again, now the thing is, think about this. If you were right on the put, thank God you didn't buy the stock, right? Because at those levels, that's a big deal. And now as far as the pricing with the call and the put, because they're basically the same, the cost there's no difference in whether you which one there is as far as how much of your return on your investment would be. But you can still see that you're looking at only a 5% of your initial outlay if you were to buy the stock. So 5% to put on a call position, buy the long call, or 5% to buy the long put. All right, so now let's get to Tesla, our big explosive stock of the decade. So when I put this slide presentation together, remember we're using the October 16th, 2020 option expirations for all these examples. So here you have the 490 call or the 490 put. Now, remember we started talking about the options. Initially, they were like $1, $2, $3. We mentioned they were like 100 and something to 300 something dollars. Here we're talking about Tesla. A 490 call costs $77.20. A 490 put costs $68.35. Now remember, that is not $77 or $68. You have a multiple of 100. So to put on that Tesla stock, now this is great. Tesla just split in half, and still to buy 100 shares, it costs you almost $50,000. Look at that, $49,832. That's how much it costs to buy 100 shares. Wouldn't it be nice if you bought 100 shares a few years ago? Well, now you'd have 200 of them at that. So, which means you'd have almost $100,000. Anyhow, you can't do that. Can't go back to the past. But what you can do is see how much putting an option position would be. So if you're still bullish Tesla, and they just had the big battery announcement yesterday and whatever, you could have put on at this time when this slide was made, a cost of $77.20 would equal $7,720. Leaving you a break-even price of $567.20 to the upside. So now it's kind of funny. You would think that looking for a almost $70 move within a period of 45 days in the stock, that's usually a lot to ask for or to even remotely think you could get. But when it comes to Tesla and the way it's been moving to the upside or the downside, if you had a buy signal and buying the call at that moment, that would be the call, your trade of the day, then that's what would cost. Now your risk, think about this, to the upside is only $7,720. Obviously, if the market goes down and continues to break, you would lose money, especially if you waited towards closer to expiration. So that's the risk you would have. But if the market goes down, I mean, obviously, if you're looking for a $60 move to the upside, it could easily have a $60 move to the downside. $60 move to the downside, well, that's the same. That's why you want to have a put on versus a call, obviously. But that's a big deal because of how much you would lose if you would just own the stock. So buying the call, definitely better than buying the stock, especially at those volatile levels. Obviously, you have you only have the time available for until expiration, but definitely for bang for your buck, for 5% of the position to catch that ride to the upside, I'd like the options even at those prices. Now remember, when the question about the VIX, if you have volatility rising, and especially this already would be a volatile stock, that's why the pricing of these options is very expensive. So you got to really know what you're doing, because even though you may think you're going to get the movement, you're going to need a lot. You're going to have to get it or more because of the pricing of your options. So that's why those other ones like Coca-Cola and IBM may not be sexy or in vogue, but you know what? If you can get your ROI and be consistent, that's what really matters. That's something to think about. But if you want to trade these high flying stocks, buy the put or the call, it's $6,000, $7,000 a position. That's all good too. Just to let you know where it went to, look at this on the day of the slide when we started it. Remember, it was $77.20 for the call. The new pricing as of yesterday was $28.89. So think about that. You lost, over $4,000 on the call if you were bullish Tesla at the time of when those options were priced out at. Now, if you were bearish and you had bought the 490 put, it was $68.35 when it started, and it's all the way up at $93.20 as of yesterday. So in that situation, you would be making over $2,000 off of the put position just in the past couple of weeks. So now when you think about it, the position cost around $7,000, you make $2,000, and you're looking at a good 25 to 30% return on your investment within just 2 weeks, without having to put up the whole $50,000 of buying the stock. So just something to think about. Once again, we have Dow. Now, unlike Tesla, it doesn't cost the same amount. It's not 35 times greater. So here we have an example again. We take the $45 call and the $45 put. Look at this pricing, $2.70, $2.35. Once again, the stock may not be as in vogue as others, but it is a very good price point. Dow, $4,500 to buy the 100 shares. Not a bad investment. It's a good company. Chemical companies, they're never going anywhere, that's for sure. The $45 strike price call, though, if you were to buy it, think about it, it's $270. That's it. I mean, that is amazing. For 5% of your investment to lay up to buy the stock, you could buy the call and trade and look for that break-even price of only $2.70, which would put you at $47.70 for this price for the break-even for the call. Or if you're bearish to the market because you think that there's going to be another second wave and the whole stock market as a whole is going to take a dip, the $45 strike price put at that point would have been $235 with a break-even of $42.65. All right, now we have Budweiser. Everyone's familiar with Budweiser. Kind of funny. You'd think that if anything, this one would be really bouncing and rallying, but I guess it's not. It is going up and has been for the past couple of months. It has bounced since the big correction back in the beginning of the year from the coronavirus trade. So this market was at 58.15. When I pulled up the slide, we have the dotted line here once again as our option expiration. The $55 strike call and put. The call was $4.80. The put was $1.54. Main reason being is that the closing of the market was very close to the price of the put. So anyhow, that is, look at this, $480 or $154 for a stock that cost $5,800. Once again, this is where you make your money trading options. Your ROI, you're not having, you have defined risk. I mean, think about it. If you're thinking about trading Tesla or even Microsoft, not that I'm saying to discourage you from trading those options, but you can expand your portfolio and trade a basket of options like Budweiser, Coca-Cola, IBM, and tried and true companies that are very liquid, which gets back to our price point issue. And $5,800, good investment, good dividend paying stock, obviously beaten up right now. So the $55 call would have been $4.80, which is $480 with a break even of $59.80. And which was very close to where the market was at. And so if you were bullish, you would pop above that very quickly and give you a good chance to make a profit on that. The put, though, interesting enough, because the market's so far away from it, you really got a good value on it. So if you even do hit your price point, let alone get a significant slide below that, you would have a big value in the put. So that's sometimes like if you have a big sell signal and the market's rallying into it, this is where you can pick a strike where you can really gain your ROI. And this is something that you're not going to catch so much in some of your bigger high flying options. So in this case, if you were bearish, I'm not saying one way or the other that was the situation. We're looking at both sides and what you would get at, what you would realize for it. But your return on investment would be much better on the put in that situation. Now let's look at Allstate Corp. Insurance companies, do you think they've been getting hit? Let's see, what happens on expiration date if you don't sell beforehand? They expire worthless, or they're in the money, so it's a cash settlement. So, but usually you're going to get out beforehand, because if you've already made your money and you only have a little bit of time left towards expiration, why run the risk of all of a sudden losing on your position? So I would always say that you should try and look to liquidate a day or two in advance, maybe even a week sometimes, if you've already realized your profit and your target. Always have an objective too on your positions. That's a whole nother, obviously, thing when we maybe have a webinar where we actually define, like, certain buying and selling situations and how to define your risk with that and stuff like that. So anyhow, with the Allstate, we're going to do the 92.50 strike price call and put. The call is $2.55 and the put is $2. So for that, the break even, and for this would be $95.05 for the call, when the cost of that option would be $255. Now look at this, Allstate, $9,300 to buy 100 shares, but you can control 100, and this is the call or the put, because we're the 92.50 is right by the $93 closing price of the stock. For $255, which is really, really, really nothing. You're looking at like for 3% of your cost of controlling the stock to buy it, you can buy the options. I mean, at that pricing, you could roll it in every 45 days buying the calls, and that would be more effective, most likely, than buying the stock. You wouldn't get the dividends, though. That's the one thing you wouldn't get. And for the put price, also, look at that. I mean, $200 versus, you know, for where the stock value is at. This is a lot of bang for your buck for ROI. So you don't need to have a big move. Just think if you have a 10% move in Allstate. You don't need to have a major move, but a 10% move with trades where you're using literally 5 to 30% of your capital that you would use for buying the stock. So whether you're being long or short by buying the call or buying the put, your ability to capitalize and build your capital base is just, you know, it multiplies exponentially. Now let's look at Apple once again. Here we go. Here, the 130 call was $8.80, and the 130 put was $9.80. Now, that's actually not too bad considering the high flyers that these stocks really are. So 129, $12,900 to control 100 shares of stock, only 880. This is, you know, for 8%, you could control 100 shares, you know, and this stock definitely moves, not quite as much as the other ones. But if you're going to look at the high flyers, this is still somewhat of a reasonable trade for their options. The same is for the put price too. Now this one would have a break even where the market had to go from, see, it was 129.04. It would need to rally to 138.80, or it would need to break down to 120.2. So this one, a little more expensive, not as good as some of those more or less in vogue stocks. So one last one before we get to the last couple of questions. Abbott Labs, the 110 call and put is what we found for this one. We made the slides. The break even is $114.45 or $1.520 to the downside. Once again, this is a position that would have cost $10,000 to put on, only $445 or $480 to put on for your call or your put spread if you were bullish or bearish. Once again, the break even, you're looking for just a $5 move basically in either direction. Not hard to get in this environment, especially when Abbott Labs is up for all the coronavirus testing. So real quick, do a couple plugs and then we'll answer a couple more questions. Yes, I wrote a book called High Probable Japanese Candlestick Patterns. And for all of you viewing today, for the next 5 days, you can get this book for free in Kindle version on Amazon.com. So if you're already a Kindle Prime or Amazon Kindle user, you just go on there and you can get the book. I think you get it for a week or 30 days for free, somewhere around that time frame. So for the next 5 days from today through the 27th, you can download that book. I'm in the Kindle version only. Paperback is purchase only. So remember to maximize your option trading potential and use e-option for your stock, ETF, and ETF option trading. Remember, they have the free option strategy tools like Options Play. They have the strategy guidebook also available on their website. You can set up a paper trading account. And then remember, ETF and stock trades are always free and option contract commissions are only 10 cents. So let's see, we got some more questions here. I do not understand why he is doing a straddle for all options. Okay, I'm not doing a straddle for all options. We were showing the difference of whether you put a call or a put on. It was not giving any, those were examples of the market was where it's at and then what would happen if you put on a call or a put. And we also showed whether you would have a stock position on too. So that's why you could see that if you wanted to be long, one way would be by buying the stock. Okay, so if you bought the stock, there was the price of what your capital outlay would be. And then if you bought a call instead of buying the stock, which would give you the same ability to control 100 shares, but only for 30 to 45 days, because there's obviously an expiration date. So if you wanted to buy instead of buying the equity, you would buy the option, and that was showing the pricing and how the return on investment and how you could also trade multiple stocks versus only investing in one. I mean, think about it. If you had just enough money to buy 100 shares of Tesla stock, okay, that's $50,000. You're done. Unless the market goes up, you're going to be losing money and waiting for it to come back or waiting to figure out when you're going to get out of the trade a loser. If you were to buy the option, the call, then you would have to much less of a capital outlay, you know, and you would also lose less. And like, for instance, at the time of the slide, if you would have bought the call, you would have been a loser, just like if you would have bought the stock. However, if you would have been a bear and you bought the put, well, then you would be up money, you know. So this webinar is not about directional trading. Yes, if you were to buy the put and the call at the same time, that would be a straddle. However, right now we were just looking at the ROI on using those directional trades. Whether you were long or short is up to you. We were just showing what would happen to you in those scenarios at that moment, one versus the other, and also showing the ROI. That's the main thing, is to show you how with options, unlike with equities, see, if you were to short the stock instead of buying the stock, then you'd have to put up all the margin money as well, and you'd have to maintain that margin money. So that's why a put is better than shorting stock, and it's definitely much less riskier than obviously than shorting the stock. Let's see, do you have the full cost of 100 shares of stock in your account before you make the trade? Well, no. If you have the ability to, depending on your account, most people have the ability to buy on margin already. So now I would always say that you have to be careful about buying on margin, because then that's being just like when you short stock, you have to maintain that margin. So yes, if you were to buy on margin, let's say Coca-Cola, let's say instead of buying just 100 shares, you could buy 200 shares if you would be able to buy at 50% margin. But the thing is, if the stock starts to go down, then you better have extra money in your account to cover it. Otherwise, they're going to liquidate your position because they have to satisfy the margin. So yes, you do in the examples that we use, because that was the whole point, was to eliminate margin. If you bring margin into the picture for the stocks, then for sure that would be a totally different comparison for the options trades. But then also that would make your long stock position much riskier than it would be normally, which would also make your long call position so much better of position. So yeah, so actually it's a good question you asked. So I hope that that's clear about whether you do or don't need to have the full cost for the 100 shares. So if you have a small account, odds are you probably have to have the full amount. You're not allowed very much margin room. So I don't know if there's any other questions. The reason I asked you to go buy a call, that's, we already answered that question. Expiration date, I think that's it for the question. So if there's, oh wait, let's see, one more coming up, I think. Just waiting for this to come out. Nope, I guess not. So I want to thank you guys once again for having me for the webinar today. And also remember that you can get the copy of High Probable Japanese Candlestick Patterns on Amazon.com for free on Kindle for the next few days. So with that being said, I want to thank you very much. You have a great day.
All right, great. Thanks, Teddy. Very much appreciated for you taking time and putting the webinar on today. It was a great educational hour here. So we just want to say, everybody, thanks for attending. We have more educational content on our website. Go to eoption.com under resources, and you'll find past webinars, trading videos, links to option strategies, and free option tools like our options play tool that's very useful. Also, like us on Facebook to get advance notice of other webinars, latest market news, and investing tips. We'll also have a video recording later this week of the webinar today, as well as our past ones. And don't forget to take advantage of our low rates, zero commission for stocks, ETFs, and 10 cents a contract for options. On behalf of eOption, thank you again for attending. Take care.